There's only one thing I love more than a 10-bagger, and that's a stock that helps you sleep at night.
We're talking about reliable, consistent and proven performers that you can bank on to get the job done.
Think about stocks like Telstra, Soul Patts and QBE. They often fly under the radar, but they rarely fail to deliver.
So if you could only own one stock in 2025, what would it be? That's what we're about to ask these 10 fund managers.
If you could only own one stock for 2025, put in the bottom drawer, what would it be and why?
I'm actually going to go with Cuscal, a payments infrastructure business. It was a very rare recent IPO on the ASX. So Cuscal effectively provides the plumbing for non-major banks, neobanks and fintechs to access the Australian payments networks. They enable services like PayID that we use day to day, and really benefits from a fantastic economic moat because their customer base don't have the scale themselves to build this kind of functionality. And so they rely on Cuscal to provide that for them. Just a really beautiful infrastructure-like business. A lot of structural tailwinds that are behind this. I mean, there's clearly the growth in digital payments. I mean, we all know that we're using cash less and less. We're tapping and going more and more. We're transferring digitally to each other with real-time payments. That's all enabled by Cuscal. So volumes are growing. Meanwhile, they're also leveraged to the major banks losing share of payments, which has been going on for over a decade. Or to put it another way, Cuscal's customers are gaining share. They're doing more, therefore paying Cuscal more. So we think this is a digital infrastructure business with great recurring earnings, long-term structural growth story ahead of it, and just one that we think is a no-brainer at the IPO price of around 13 times price to earnings.
One particular small cap software company that we really like, it's called Gentrak. We've owned it for quite a while, and it recently printed a really stellar full year result. But we think there's still a lot to like. In particular, the tailwinds going forward. This company is a mission critical billing and CRM software for utilities and water companies. It also has a mission critical ERP system that's used by over 150 airports across 25 countries. So two pieces of really great software. But in particular, the tailwinds is that globally, utility and water companies are going through a once in a multi-decade period software refresh program. They're moving off legacy incumbents, SAP and Oracle. They're needing to revolutionise because of deregulation in the energy markets, because of renewables and electrification that's forcing them to upgrade their software systems and their billing. And Gentrak is really well placed to continue to win share from these legacy incumbents. And what the CEO keeps saying is there's not that many players on the pitch. They're really just competing against the likes of Kraken and Kaluza, but it's a very big pie here, a global opportunity. So we think they're really well placed to continue to win. Fantastic management team. Massive history of under-promising and over-delivering when it comes to their results. We think that that will continue. We still think as well, despite the re-rate, that it's very attractively priced. They just delivered over 50% underlying revenue growth and over 40% underlying earnings growth.
It's a Kiwi stock, would you believe it, but it's dual listed, so it's listed in the ASX as well. It's not as well known as many would think, despite all the attention on data centres and AI. The stock's Infratil. It's a global infrastructure investor. And where they're spending their money, digital infrastructure, healthcare and renewables. Now, if you put those three themes on the list of Livewire readers' themes for the next 20 years, they're up there, right?
Yeah.
And these guys have got exposure to it. And probably the most interesting asset that they have is they've got 48% of one of the largest data centre operators in Australia, known as CDC. This data centre has been an incredible asset. It's continued to grow. It's got over 400 megawatts of contracts that are currently in negotiations and likely to be rolled out over the next kind of 4 to 5 years. That's just one asset. They've also got a large renewables business in the US known as Longroad with a large solar portfolio. On the cash flow front, they also own the number 2 telco in New Zealand. That generates a heap of cash and helps fund these growth investments that they've got in infrastructure and renewables as they continue to plough capital into it.
The key stock I would pick would be Life360. The reasons for that is it's getting margin growth. It's got a aspirational target of $1 billion. What's important there is you hit that target and you get over the 25% also aspirational target, then you've got a $250 million, put it on an even multiple of the market of 12 times, which is very conservative given that it is growing its top line over 30% and is net cash and growing those margins. And then you've got, a valuation that's well over $3 billion versus the $1 billion it is today.
There's a company that we think is trading at around a trough valuation, but has exposure to some of the best end markets in healthcare. It's a company called Danaher. It's very well known, been around for a long time. But basically, it's a diversified healthcare company that gives investors exposure to a re-acceleration of the biologics and the biopharma industry. So during COVID, many of us have been aware that they've actually had their customers slow down orders. They ordered too much. And we think that Danaher not just gives you exposure to the biologic and biopharma industry re-accelerating from a 2-year drought effectively, but they also have exposure to China through a lot of their testing equipment for these types of drugs that has been really slow as China's recalibrated their economy. So 2 key parts of acceleration, and they've also got a third business unit, which is diagnostics, which continues to take market share and is durably growing. So it's a bit more durable, it's trading at a low valuation, but you still get that re-acceleration from China and general biologic drugs going back into an upcycle next year.
They are one of the leading specialty investment platforms in Australia with a focus on high net wealth advisors. And we actually met with one of their advisor groups in Melbourne a couple of months ago, and he essentially said, there's other platforms that have come and spoken to us about their offering and they can't do what Praemium can do. They can't offer what Praemium can offer. So I think that was real validation for what they're doing and the software that they're providing. The tailwinds going into 2025 are around, they've just recently put through some price increases on their platform. They're also putting through, which should annualise next year, and they're putting through some further price increases on their admin side. So they do kind of back office portfolio admin. They could be in the range of 20 to 30%. And then finally, they've got a new platform offering, so Spectrum, which combines the best of both of their current offerings into one. It's a great suite for both custody assets and non-custody, so anything that you have off platform. And why the share price has run in the last month is they've actually won their first big client onto that platform. That was Euros. So $2 billion of FUA is going to come onto that platform, and it's just kind of validates what they're doing. 1 month or 2 months the software has been launched and they've already won a big deal. So I think there's really good momentum and tailwinds into the new year. And the great thing is it trades on about a third of the multiple, maybe half now, of Hub and Net Wealth.
The one stock that's had a good run, but we think there's more to go, is Myer. So that's predicated on the merger with Praemium Group's apparel brands business. Firstly, the time the deal's expected to complete, the RBA is expected to cut interest rates for the first time, so we think that bodes well from a consumer outlook position. Secondly, the management have flagged about 30 mil of initial synergies from the merged entity. That's in the context of a $1.4 billion cost base, so we think that this looks very conservative. Thirdly, industry veteran Solomon Lew is going to own about 30% of Myer post the transaction, and he's coming back onto the board after 22 years. So we still think that in the context of an improving top line, getting the basics of retailing right, getting private label penetration across the women's apparel range, as well as expected sort of synergies from a cost perspective, we think that's a good year for Myer in 2025.
Alcoa we do like as well in the aluminium space. We think Alcoa, it's the US listed aluminium go-to name. Again, going through a lot of self-help with their earnings. They're cutting off high-cost assets or high-cost operations, and they've moved upstream in terms of they purchased Alumina Limited this year, so that's really added to their portfolio on the upstream side. I touched on the benefits of aluminium earlier, but also alumina, which is the feedstock. So we really like Alcoa.
Supply Networks, or SNL, is probably my pick for this question. Just given they've got a really backable management team, they're super aligned with shareholders, owning more than 40% of the shares on issue. They've done an incredible job growing the business. Their NPAT has tripled in the last 4 years, and their return on capital metrics are above 40%. They're an aftermarket provider of automotive parts for the truck industry. They're a distributor. And I think when you look at just the quality of this business and how they've been able to grow and allocate capital in a way that's really sustainable, that would probably be my pick.
Hard to believe trucking parts can provide such incredible returns.
That's right.
One stock that you could hold in almost any environment would be Haleon. It's a consumer healthcare company, and I think we can all agree no matter what happens in the world, people are still going to get coughs, colds, headaches and things like that. And in those situations, people gravitate towards brands they trust. And Haleon has a portfolio of those brands, including Advil, Panadol and Voltaren. The company was spun out of GSK and it came to market with a lot of debt.
and it's rapidly paying that down. And as they pay down that debt, they should have capital available to invest in growth and return to shareholders. We've met with management a number of times over the years, and they're really excited by what they can do as a standalone company in terms of growth and also increasing efficiency.